Welcome to the ThePaperTrader.Finance. All data, no risk, trading for the sake of learning. This is not financial advice. These trades are for educational purposes only. Results may vary. Here at the ThePaperTrader.Finance, we're kicking off the new year by creating a SoFi Bro $1 billion paper trading account. We will be making all sorts of SoFi trades, so make sure to follow the journey. Let's head over to the options chain and start adding 10 contract positions to control 1,000 shares. Unlike a traditional equity purchase, an options contract has an expiration date, and the contract price does not move one-to-one with the asset price. Each contract is comprised of 100 shares of the underlying asset, and the contract price has intrinsic and extrinsic value. The intrinsic value is the difference between the contract strike price and the current asset price. The extrinsic value is the difference between the intrinsic value and the contract price. By purchasing 10 contracts, we are entering into a legally binding agreement, buying the right, but not the obligation, to own that asset at a strike price within a specific time frame. We can also resell the contract itself prior to expiration. Let's start with some shorter duration contracts that expire in just a few weeks on January 23rd. Scroll down to the $23 strike price, and we have a contract with lots of intrinsic value, often referred to as deep in the money. This contract has a 91 delta, meaning that the first $1 of asset price move will correspondingly move the contract price by 91 cents. This delta will dynamically adjust corresponding to the contract's gamma value. We will submit a market order for 10 contracts, hoping that our order doesn't fill too much above the $4.20 currently being asked. While that processes, we can head up to the $24.50 strike price. This contract has an 81 delta, meaning that for the first $1 of asset price movement, this contract will yield 10 cents less of a move than the prior contract. It also has about 33% less intrinsic value. Why would we buy a contract with less intrinsic value that correlates less to price movement? One reason is that price of the contract is $1.45 cheaper per contract. Less cost equals less risk and potentially less reward. That balance of risk and reward is exactly why we created the SoFi Bro $1 billion account. It gives us the ability to trade and track any strategy while assessing the performance. It's the kind of learning that's only possible when a billionaire decides he is a SoFi Bro. Okay, let's move up to the $25.50 strike price. Asking price is $1.97, and our delta is now 70. Now let's buy a couple contracts that are straddling the underlying asset price. First, the $26.50 strike. This is the last contract in the money with any positive intrinsic value. The ask is $1.35. This contract has a 57 delta and current gamma value of 14. That means that the contract price will correlate 57 cents with the first dollar of asset price movement, then drop to 44 and so on. The $27 strike is our first out-of-the-money contract. Out-of-the-money contracts inherently have no intrinsic value. All of the $1.09 value is derived from extrinsic factors such as time and implied volatility. The contract has a 50 delta and only needs a positive 22-cent price move to find itself in the money. Although it has no intrinsic value, it's more likely to return a profit than strike prices even further out of the money. As we move up to the $28.50 strike price, we see that the asking price is now just 57 cents. That's $3.63 cheaper than the $23 strike contract we purchased. Our delta is now at 30. Quite a drop off from the 23 strike contracts, which had a 91 delta. Next, let's buy the 30 strike contracts that have an 18 delta and asking price is just 27 cents per contract. To finish off our January 23rd purchases, let's buy two of the least likely contracts to expire in the money. The $31.50 strike, which is a delta of 10 and asking price of 15 cents per contract. And the dark horse of all dark horses, the $40 strike. With a delta of 1 and asking price of just 3 cents, this is the type of gambling that may require an intervention. Only billionaire bears trading paper and the most core SoFi lords should ever find themselves in this dark, smoky part of the casino. Now that we have a complete range of options contracts expiring January 23rd, let's add comparable contracts in the coming months and years. Let's go to February 20th. Buy contract from a 91 delta, $20 strike all the way to the dark horse $40 strike. Then we will repeat again for March 20th, June 18th, September 18th, and January 21st, 2028. In total, we purchased 49 options contracts spanning the next 2 years. This will provide us with data to analyze in regards to theta decay and implied volatility. Here's to SoFi bros everywhere. May you be swimming in Lambo-shaped pools before we can make our next paper trade. And to the haters, take solace as the seller on the other side of every horrendous paper trade we made.